All right. What's up, everybody? So we back again. We got Chris here. We had a chance to catch up a little bit, but first off, welcome to the channel again. It's great to have you back.
Thank you. Appreciate it.
So we were talking just a little bit about some of the things that you've been working on and some of what you're doing with your channel and whatnot, potentially opening up the lens a little bit. So do you want to share a little bit about that?
Yeah. So I recently did a video called I Need Your Help. And I basically just I made a video just asking my audience, what they thought of expanding the focus of the channel to stuff that's a little bit broader than options. Because for the past 5 years, my YouTube channel was strictly about options trading.
Mhm.
But over the years, my personal philosophy has changed and I've learned a lot myself about all these other ways to manage your money and invest. And I just wanted to kind of branch out and start talking about some of those things, but not necessarily a hard shift away from options, just, still doing the options stuff, but having the opportunity to make videos here and there about other things. So I got pretty overwhelming responses and pretty much everyone was on board with talking about other stuff. And I kind of had validation already from that because in YouTube analytics, you can see what your audience watches. So it tells you your audience watches these videos, your audience watches these channels. And so my audience was already watching, stuff that I would want to talk about. So broader financial topics, mostly within the investing niche, maybe some personal finance stuff here and there, but it all kind of ties together. But yeah, I decided to just go ahead and broaden the scope. So rebranding from Project Option to Project Finance. And like I said, there will still be lots of options focused content, and I'll still be doing live streams, which will be options focused, since I'll be sitting there with my trading platform open, talking about positions I have on,
Right.
and yeah, so still going to be a lot of option stuff. Just going to start sprinkling other topics in that have been exciting me and that I definitely want to make videos on, just to help spread the word. So I'm really excited about just broadening the scope and having everything under one channel, because before I was contemplating having a second channel, but as we
Got it.
know, if you build an audience once on YouTube and you have the audience on one channel and it's still similar content, then it doesn't really make sense to make a second channel, because you'll get way less views on those videos and then it's just not as efficient. So, and from a focus perspective too, it's really hard for me to focus on two different projects at once. So I'm really happy that everyone was on board with broadening the scope and just keeping it all on one channel, so long as there are playlists separating it all so people can navigate and find everything easily. So
Yeah.
super excited.
That's awesome to hear, honestly, just because I think one of like the things I have found most valuable, same as you, I'm 30, kind of going through a similar series of learnings. And a big thing that I've started picking up is just the value of looking at other business ventures. And it can be as
Yeah.
simple as like we were just talking about, like if you wanted to trade and then maybe have some interest rates or something, like something really simple that you were trying to earn a risk-free return on, but we'll get into that in a minute, just that's starting to look a little different.
Hmm.
It's helpful to find other things to start looking at and include into your overall, I like to call it just an overall wealth portfolio. So I'm actually really excited to see some of the stuff that you talk about. It's something that I think, especially digging into things like real estate, there's just a ton of really, really great information out there for traders that might want to be dabble and stuff like that. So I
Right.
think, yeah, I think it's really cool that you're kind of opening that band a little bit. And then the other really neat thing I think people get out of that is they get to go along that experience with you, right? And kind of see the stuff that you're currently interested in, why you're interested in it. I think there's a ton of value in that too. So super, super cool to hear. Glad to hear that everybody was really supportive of that. Cause I mean, honestly, I'm definitely looking forward to seeing your
Yeah, for
perspective
sure.
on some of that stuff.
It was a big relief for me as well.
Yeah. As soon
Yeah.
as you said the two channels thing, cause I mean, I'm obviously a small channel. I've got like 5,000 subscribers, but still I can only imagine, trying to like apply that equal effort to run another channel just as good, like just as
Hmm.
well, man, that would be exhausting.
Yeah, it's a
So
lot.
yeah, that's really good to hear. So we were actually just kind of, having a conversation and I shared a little bit of what we were discussing. And it pertains to kind of like the current markets and how things are currently situated, what we're seeing as traders and investors. One of those things that we were talking about was um, some issues, or really just a change in paradigm, really, as it pertains to returns on risk-free investments or lower risk investments, stuff like that. And you were sharing your perspective on that. So I actually thought it'd be cool to dive into that a little bit further and kind of see what you're seeing as it pertains to that, and just where we're going from here.
Cool. Yeah, I'd love to talk about that. So I'm working on a video right now that should be out this week. So this is the week of the 26th.
Hmm.
Um, so yeah, this video will be out this week. But the premise of the video is talking about how this is a tricky investment environment for investors because typically you have different choices of investment products with lower risk, lower returns to higher risk, higher returns. So lower risk, lower returns would be something like a cash position would typically be your safest position. Savings account would be basically cash, but it's earning you a little bit of return. And then you have government bonds or different types of bonds. It could be corporate bonds. And then you go to the higher risk spectrum, which is stocks, maybe real estate you could consider higher risk. And then you have stuff right now in the new age world, like cryptocurrencies, including, Bitcoin, Ethereum, or Dogecoin, if you're so inclined. um, but the interesting thing is right now on the lower end of the risk spectrum, you can't get positive real returns. So for those who may not know, real returns are when you take the return of something and then you subtract inflation. So if inflation is 2%, excuse me, if inflation is 2% and you earn 3%, then you're said to have a positive real return of 1%. And if inflation is 2% and you earn 0%, so like if you have a cash position, that earns 0%. But if inflation is 2%, you have a negative real return because your dollars have actually lost purchasing power. So your
Right.
dollars next year, if prices go up, which is inflation, then your dollars that didn't grow at all can buy fewer things. And so that would mean you have a negative real return. So it's a tricky environment right now because Wealthfront actually just sent me an email the other day, and they said we're dropping the interest rate on your high yield cash account
Oh, good.
from 0.35% to 0.1%.
Mm.
So if you have $10,000 in a Wealthfront cash account, then you're going to earn nothing. You're going to earn like $10 a year,
Right.
which is, and if inflation, as I said, if inflation is expected to be 2%, which has kind of been the Federal Reserve's target, that's the higher end of their target. If inflation is 2% and you earn 0.1% in your cash account or your savings account, then it's the same problem I discussed before, where you have a negative real return, where prices are rising faster than that investment position. And you see the same thing if you look at a 10-year bond. So the 10-year bond yield is less than 2%. The 30-year bond yield is just over 2%. But the thing is, if the 30-year bond yield is at 2.2% and inflation is expected to be 2%, or that's the target, then you're barely keeping up with inflation in that position. But right now we are kind of in uncharted territories because we have never seen so much money printing in the history of our country. So if you look at the chart of the money supply, it's literally like it's a straight up line
Hmm.
over the past year. And naturally, if you create more units of something, it dilutes the value of each unit that currently exists. And so I think right now there's a lot of high inflation fears. So we're not talking about 2% inflation. That's kind of
Right.
the normal world expectation. People are worried about, 3, 4, 5%, maybe even higher. And so I think if you're an investor and you're looking at a 30-year bond, which has a 2.25% yield, and you're expecting inflation to potentially go higher than 2%, then you're not going to comfortably put your money into that position because number one, you're getting paid your coupon payments back in US dollars. And
Right.
then at the end of that 30-year term, you're getting your principal back in US dollars. And if you don't trust that the US dollar is going to hold its purchasing power, then you're not going to comfortably put your money into that position. And so with the lower end of the risk spectrum basically off the table in terms of getting positive returns on your investments, you have to look to higher risk assets such as stocks. We could say real estate's in there, um, cryptocurrencies, or something like art if you're savvy and you know how to invest in art. But you basically are forced into these higher risk assets. And I think when we talk about the markets, you're actually seeing that fear and you're seeing that
Right.
forced hand because we were talking about this before. If you look at where the S&P 500 was at the high before coronavirus, and then you look at where it is now, it's over 20% higher than it was when the whole global economy was open and before the coronavirus started. And now the world economy is not yet fully reopened, but the stock market is 20% higher than it was before all the mayhem started. And so I think that's partially a function of people not having any return potential in the lower risk assets. And so they're basically being forced into the higher risk assets, which is causing the prices to increase. And the same thing with the real estate market. I was looking up some data today, and from January 2019 to January 2020, based on the housing index that I was looking at, their price index increased like 6%
Hmm.
from January 2019 to January 2020. From January 2020 to January 2021, that same index has increased 12%. And I've experienced this firsthand because I've been looking at the real estate market in Denver over the past few months. And I actually started working with a realtor and I got connected with the MLS system. So I could see all the new listings come up. And there were a couple properties that I favorited, and they went off the market in like 5 days. And they
Yep.
went for $50 to $75,000 over the asking price.
Yep.
And so I think there's a ton of demand to get out of cash, and any cash denominated investment product like I described earlier with you pushing up asset valuations across the board on the higher end of the risk spectrum. So getting back to what I think about markets, I'm actually bullish on the stock market. I'm actually bullish on pretty much everything that's not cash based on the monetary policy that we're seeing. I think
Right.
for as long as we have the money supply increasing as quickly as it is, and rates are extremely low, like mortgage rates are at historic lows, and loans you could take out loans and you can buy that house. The the payments on that debt are so low, and it's actually a strategic thing to take out debt
Right.
if you think the currency is going to lose value, because
Right.
inflation kills debt. So I don't want to be a doomsayer about hyperinflation and say that we're right behind Venezuela's footsteps. For those who don't know, Venezuela saw hyperinflation where their currency basically it loses 90% of its value every few months,
It
essentially.
was crippling. Yeah.
Yeah, so that's what happens in a hyperinflationary environment because people lose faith in the currency. And if that's the case, then people aren't going to accept that currency as payment, or they're going to accept way higher units of that currency. So,
Right.
uh, but anyways, I don't want to be a doomsayer. I don't want to say that hyperinflation or a Venezuela type event is coming for the US, but I think that right now, based on the monetary policy, it is creating rapid increases in all these asset prices. So as long as we have a monetary policy like we do right now, then I am bullish on high risk positions. So I'm bullish on stocks.
So, what are some changes in monetary policy that would make you change your thoughts?
Well, so right now we're in an easy money monetary policy, which basically means that they're just, they're printing as fast as they can. I think if they said that we are going to start contracting the money supply, then that would change, that would change the minds of a lot of investors. That would
Yes.
also, we would see higher interest rates because of that too, because there'd be less money in circulation. Um, but yeah, I don't know if we're going to see that, at least in the next few years.
It
So,
seems it's I'm glad you bring that up, honestly, because that's the one thing I've been telling people that I'm just watching like a hawk whenever I see any of the Fed talking about money, is to see how they're talking about printing money. Everybody's curious about interest rates and stuff, rightfully so. But I do think there's a lot of predictive capability in just production of currency.
right.
One of the things that I also was talking about, I forgot what the video was, but it was essentially just talking a little bit about the Fed and how they've been. And curious to hear your thoughts on this. But for me, it seems like we've been in what, at least 8 quarters now almost, where like the Fed has been talking about doing something, and it seems like they're kind of backing it up. They're continuing on what they said that they were going to do. Whereas there definitely has been a period of time before that, and I shared a couple examples in the video where the Fed was kind of talking one thing, and then pretty quickly down the line, something else came out that just shocked a few people in terms of the overall approach. So I'm just curious, what are your thoughts in terms of the Fed's consistency lately as it pertains to, we're saying we're going to do this and this is what's going to happen, sort of thing?
It's an interesting question, and I have to say that I'm not by any means a macroeconomic expert, but I have been trying to get into more of this and understand how all the pieces fit together. But the main concept that I've kind of bit into recently is just the concept of, if you rapidly inflate the supply of money, there aren't going to be there are going to be consequences. Like,
Yeah.
what they're saying is, we can just inflate the money supply and we can create all of these additional units of US dollars, and there's not going to be any negative side effects, which you can't you can't get you can't get something for nothing. So
Right.
there are going to be side effects. And I think, to answer your question, I don't see them reversing course abruptly, because they have already gone down this path far enough. And a lot of people in this space that are much smarter than I have said that they they basically have their corner. They have no easy way out of this, and they have to
Right.
basically continue on this path. Because if they did reverse course abruptly, that would, that would send shockwaves through the whole financial system.
Yeah. And I think it's completely accurate, and something that whenever because I always like to read the minutes, and some of what I was picking up is it really doesn't seem like they even identify viable alternatives for what they're doing. So I think that kind of just reinforces what you were sharing, just in terms of this is kind of what they think is the best path. And that's why I'll have some people come up and just have conversations about the Fed's history in terms of continuing to execute the policy as stated. And that's more or less, I think the punchline here is that just it doesn't seem like there's a lot of really great alternatives for them to drastically switch gears to. So it's
Right.
yeah, it's interesting to hear you kind of seeing the same thing. So on that same vein, we're kind of just talking about the markets and some of the layout on what we're seeing. One of the questions that I got in was, um, what are some of your kind of preferred strategies for the current market, for the current environment? I know for myself, it's definitely been doing my best to find opportunity where I see it. Luckily, there's been enough volatility in things like index ETFs in a lot of instances, so I can kind of stay in a bigger product, but still collect what I need to collect, primarily sell premium like a lot of people.
Yeah.
But curious to see, what's been working for you.
So the main strategy that I've been using for the past like 6 months, I would say, this started last year too, when we were deeper in the correction and kind of ascending out of the depths of the correction, is I started buying out of the money calls in the furthest expirations that were available. And I was doing this in select names, and I've actually done it in the S&P 500 as well. But the whole backdrop for that decision was, first of all, at the trough of the stock market correction, and when we started to bounce off of the lows in March, I was assuming that we were just bouncing and we were going to see another
Me too.
cratering to the downside. And so I started betting against the market pretty heavily, and I started to burn a lot of money very quickly because I was paying all this money for these downside
Right.
profit positions, such as buying upside VXX calls. So VXX is a volatility product, and as the market goes down, the VIX index will typically go up, and the VIX index going up will bring the futures with it, and VXX tracks the VIX futures. So VXX is essentially going to have very similar movements to VIX with some nuances. But I was buying out of the money calls in VXX with the assumption that we were going to see another deep correction to the downside, probably even lower than the lows that we saw previously. And so the market kept going up. And this was when the Fed started to come out and, started saying that they were going to put all this money into the system. And the markets responded very favorably to that. And now I understand why, is because they
Right.
basically were they call it the Fed put. So the Federal Reserve was kind of the backstop on the market.
Right.
And they would come out once a week. And every time the market was down, they would come out and they would say something that would re-encourage investors. And so I realized that it was probably a foolish game to bet against the market. And I completely flipped the cards. I said, I'm not going to bet against it. I'm going to, I'm going to be bullish in this environment just because it's very clear that what the government says, what the Fed says, that's what the market's going to follow. And it's more likely that they're going to come out and say stuff to, soothe the market as opposed to lead to more chaos in the markets. And so I completely flipped the cards. And I also started doing research on some individual stocks, and I found some compelling cases for Tesla. So Tesla was one stock that I bought out of the money calls, super far out expirations, just to give those positions a lot of time to work out. It wasn't like I was doing, short term,
Right.
7-day bullish calls. So I was going far out in time to give myself time to be right. And I was choosing kind of crowd favorite stocks such as Tesla. I also did one of these positions in Nvidia. I had one of these on an Amazon, which I got out kind of prematurely, but I also did the same strategy in SPY, which is the S&P 500 ETF. So I basically put on all these long call positions out of the money. So I got a lot of leverage. So I could buy a lot of contracts with the same amount of money that you could buy with, if you bought an in the money contract, so to
Right.
speak. So if you buy an in the money, you're going to pay way more for it. But with that same dollar amount, if you go out of the money, you can buy more contracts and therefore get more leverage. And that's what I wanted, because since I was so far out in time, I figured that there was a pretty good chance that if this trajectory continued, then those calls were going to make a lot of money.
Right.
And I didn't anticipate the extent of the upside movement that we saw, but that strategy worked out really, really well in the coming months. And then I started to actually build on that strategy. So instead of just buying out of the money calls and sitting on it, I actually realized that if you get to a certain profit point, not a specific profit percentage, but if you're right on that play and your long calls that you purchase become really profitable, then that means you can find higher strike call options that are trading for the same amount of money, if not more, than you initially paid for those long calls. So, for example, if I buy an out of the money Apple call for $10
Mhm.
and it goes to $20, then I know there's a call option at a higher strike price somewhere that's worth $10.
Right.
And so if I can sell or short a call option against the one I already own, but I can short it for the same premium that I paid initially for the long call, or even collect more, then I create a risk-free trade.
Right.
And so that was a no-brainer for me. And that's become my favorite strategy, is to essentially buy call options. You can do this on the put side as well. But if you're bullish, if you have a bullish assumption, you buy call options, and if you're right about that prediction and the stock price goes up in quick fashion and you get a really healthy profit on those calls, then you can actually you can short a higher strike call and collect the same amount or more premium than you actually paid for the initial long, and that creates a risk-free trade. Or
Right.
if you collect more on the short than you paid for the long option, you get a guaranteed profit scenario.
Yeah.
And so that's what I've been doing essentially. And another benefit of that is you are able to stay in the trade without closing it. So you
Right.
can stay in the trade and allow for more profit potential, but it's not the same as closing the whole trade, such as just selling the calls outright. So a lot of people will ask me, why don't you just sell the calls for the profit? Why did you spread it off? And it's because I can allow for more profit potential, since these options or spreads at this point, they have so much time until expiration. If I have a risk-free call spread where I can make twice the profit that I already have on it, but it has 600 days to go, that's a pretty good situation in my opinion. And
Yeah.
then one layer deeper than that is if you do that strategy. So for example, let's say I bought an out of the money call on Tesla. Tesla shot up. I shorted a higher strike call and I created the risk-free spread. I sit on that. And if Tesla keeps going up, then my spread will continue appreciating in value and I'll see more and more profits come in.
Right.
Or what can happen is Tesla might crash, and then that short option that I sold will have lost a ton of value. And so I could buy back that short option. And basically, that would be sort of a, wouldn't be a day trade, but it would be trading in and out of that short call that initially was to remove all of my risk in the trade. And if the stock price collapses after I shorted that call, then I can buy it back for a big profit. And then I'm right back where I was in
Right.
square one, except I've actually reduced the cost of my long call, so to speak.
Right.
So I'm trying to give some numbers here. So the actual trade that I did was I purchased the 900 strike calls in Tesla, and they had 2+ years to expiration. And this was when Tesla was at like, $400 or $500 a share. So they were way out of the money. Then Tesla shot up to 800 or 900. It was probably like 800. And then I shorted the 1500 call, but I paid $100 for the 900 call, and I was able to short the 1500 call for $230.
Right.
So basically, I created this call spread where I had collected $13,000 for entering a call debit spread,
Right.
but it wasn't a debit because I legged into both trades. But then what happened is Tesla actually tanked. So I was actually able to buy back this 1500 short call. I bought it back for like $130, which means I profited by $10,000 on that short call portion.
Right.
And since I made a $10,000 profit on that short call and 10,000 was the initial outlay for the 900 call, I effectively removed all of my risk from the trade because I did a little in and out trade on that short call by shorting it once
Right.
Tesla went up. And then once Tesla went back down, I was able to close it out. And then what happened is actually Tesla went back up, and then I shorted it again for a higher price. So one of the cool things with that strategy is that you can actually trade in and out of that short option that you add to the trade to remove all your risk. But you actually you're in a really good position in terms of your chess moves, because if the stock price keeps going up, as I said before, your spread price will continue to increase and you will continue to make money on that position. But if the stock price crashes, then you can actually exit that short call position, harvest some profit from it. And then if you still have 600 days or whatever on your long call and the stock price goes back up, you can sell it again. And so you can kind of trade in and out of that short option. So I think it leaves a lot of room for having a stress-free position that you can trade in and out of strategically. So
Yeah. I think
I
there's a
hope
lot
that
of,
made sense. I know I covered a lot of information there. It's probably pretty confusing, but
yeah, I think
um,
most people will probably be able to keep up with it. Especially because for me, one of my favorite strategies is it's a leap diagonal. So it's a very similar setup to what you're talking about. Obviously, the big difference normally is for my short, it'll be a little closer.
Yeah.
in expiration. But like the way that you kind of talk about setting it up, it's really beautiful to kind of give it a little time before offering that short
Yeah.
because of exactly that benefit. I think that honestly, it's a really, really good approach for me. I've always done kind of, I guess, a derivative of that where a lot of times when I'm setting up a leap diagonal, the first set of shorts that I offer might be like a third of the overall position, something
Okay.
like that. So
Yeah.
it's a similar idea. I actually, I thought it was hilarious. Two things though, when you talked about kind of the COVID drop and kind of thinking that we were going to go down further. So then you started buying, and that I did the same exact thing. So I had like some short, pretty much I always carry some sort of short puts in IWM and it's more or less a covered strangle play. So I'm
Yeah.
always modulating, what I'm offering to that. But as soon as we started rallying out of the bottom, I didn't believe it. So I was like, well, I'm not going to start adding more, short puts here and getting, stuck holding a bunch of positions waiting for it to unwind. So I did the same exact thing. I started buying leaps and then kind of again doing my leap diagonal strategy. But um, I think that like exactly the approach that you shared makes a ton of sense when there's like those really strong rallies.
Yeah.
It's a really, really good way to go. I was
Right.
always yeah, I honestly commend you for being patient enough to let that happen. For me, I was always like
Yeah.
I was waiting for the drop. That's why I immediately put the shorts back out on top of it because I was like, this is gonna go back down. So that's like really good on you for being able to do that.
Yeah. Thank you. That brings up a good point, and I want to clarify a couple things too. So, first of all, yeah, you have to be patient with that strategy because you obviously need a big movement in your favor before it will be possible to create that risk-free spread.
Yep.
Second thing I want to say is that I go into those long call positions accepting the fact that I could lose 100% of what I paid for the option. So this isn't something where, if I have $25,000 in an account, I might not, I'm not going to put $25,000 into one long call strategy. I would probably put like 10% of the account into it,
Right.
knowing that that's a highly leveraged position that it can, even though it's a small portion of the account, it can still drive super strong overall account returns.
Right.
And so that's another thing is with these positions, it's not like I'm not putting 100% of the account into these long call trades. They make up a small portion of the overall account value,
Right.
but they still have a lot of potential to drive really strong overall account returns. And I think also since they are a smaller portion of the account value, that gives me peace of mind in being able to hold them longer.
Yeah.
Whereas if you had a much larger position, like you put your whole account into a long call trade and it goes, in your favor for a few days, maybe a few weeks, you are probably going to be inclined to spread off that position prematurely when you can get a much better position overall if you're just a little more patient.
Right.
But at the end of the day, like you still need that movement in your favor. I'm not going to try to make it sound easy, but
Sure.
it was just a really, really well performing strategy over the past year or so.
Yeah.
Um, and then another thing I wanted to talk about is people ask me, well, how do you choose the stocks to do this in? And it's a really hard question to answer because, like I said, you have to be right about that directional movement, and therefore you should be putting it on in a stock or company that you have a high conviction will actually move in your favor, not immediately, but over the course of that trade. And this is why I like to go super far out in time,
Right.
is that people will say, well, you're buying those options that are 750 days out, but you're paying so much for them. And I'm comfortable paying the higher premium for those longer term options because I know that it's much easier on me psychologically
Yeah. And there's another
not to
benefit
not
there.
have to not have to pearl that prediction and be 100% right about Tesla going up $100 in the next 7 days. Otherwise, I lose
Yeah.
everything.
And
So
the other really good benefit there too that's definitely worth mentioning is just for a lot of people, if they're buying far out of the money options that expire in 2 weeks, sure they're cheaper, but theta is not doing you any favors. Whereas
right,
once you're out that far, realistically, you're doing a great job minimizing the impact of theta. So yes, it's
yeah,
more out of your pocket up front, but you have a higher expectation to at least collect something on what you're putting out there.
right. And I think if and in that same vein, I would choose companies that are pretty well known. Like the companies that I've done this exact strategy in are Tesla. I have an open position like this in Apple, but this is the Apple position is it's not super successful right now. But I've actually with the Apple position, I bought calls and Apple went down and those calls went down 50% in value, but I still had a lot of cash on the sidelines because that position was small, which is
Hmm.
what I got back to what I was telling you about before. And when those options were down 50%, what I did is I actually bought more of those contracts. So I initially had 5 contracts, bought them for $9 each. They went to $5. And then I bought 5 more contracts at $5 each. And I actually went one expiration further. So these options had like 730 days at the time of entering. And so now I own a total of 10 contracts, but the average cost per
Right.
contract is somewhere around $7 to $7.50 as opposed to $9. And getting back to what I said before, I'm very comfortable having that position on an Apple because everybody loves Apple. And I think also with the upcoming 5G revolution, I think Apple stands to benefit immensely from that. And so I'm comfortable having that long-term position on in Apple.
Let me tell
But
you, if they don't bring back the thumbprint, I'm gonna throw a riot because they need to bring the thumbprint back.
yeah, I forgot that they got rid of that. I have the Face ID, the
Yeah.
Face ID phone now. It doesn't even have the thumb button anymore.
Uh huh.
Um, but yeah, so the stocks I've done it in is Tesla. I have done it in Apple, but as I said, my Apple position is not super successful right now. It's probably around break even, maybe up very slightly. I have positions like this in Square. I did this in MicroStrategy, which was a Bitcoin related play. I have some of these in NVIDIA. Um, I have some in Visa,
I'm
and I do
waiting
have
for.
some in SPY. So when in doubt, if you have the assumption that the market is going to go up on average each year and you're comfortable with that thesis that overall the market goes up long term, then I think SPY is a great product for this exact strategy because it's a very liquid product. So you have tons of activity in there in the options. And it's not like you're trading some penny stock where nobody knows about it and the options have no liquidity and you're
Right.
just putting on these long calls just to kind of throw a Hail Mary. So I think when in doubt, if people just stuck to the indices, so SPY, QQQ, IWM, I think that would be, that's a good piece of advice that I can give. But other than that, if you have a specific company that you have a high conviction on over the next 1 to 2 years, then I think this strategy works nicely. But
Yeah.
as we talked about before, you have to have a small enough position sizing where you don't care if it goes to zero. So you have to be able to hold, and also you have to have that conviction and be patient if it does move in your favor, because if you spread it off too early, then what's going to happen is you're going to have a narrow call spread. And if you have a really narrow call spread that has 700 days expiration, it's really not going to move much.
Right.
You really need all of that time decay to come out, and you're basically going to have to sit there and wait for 700 days, even if that spread gets fully in the money, to see that spread's value increase. So that's why I like waiting longer, is because if you're spreading off the trade when the stock price has gone up a really good amount and you're able to get a really wide call spread, that's my ideal situation. So in the Tesla example, I bought the 900 call and then I was able to short the 1500 call. So that's a
Right.
really wide call spread. And that's what I want for a position that has 600 days or more to go. I wouldn't want to buy the 900 call and then spread it off with, the 950 call, because to me, you're basically just selling the option at that point. Like
Right.
this is actually an interesting thing to think about. The closer you sell, if you're going to spread a trade or you buy an option and then you're going to short an option against it, the closer the short option is to your original strike, the closer it represents just closing your original option. Because
Right.
if you think about it, if you think about the same strike, if you buy the 900 call, stock price goes up, and then you short the 900 call, you're effectively just closing your original position.
Right.
But if you shorted the 905 call, you didn't close your original 900 call, but you've shorted an option that's so close to your original strike that it almost represents just selling the original position.
Right.
So what you can think about is the further away the strike is or the wider the spread, it's basically like taking a profit on a smaller portion of that trade, if that makes any sense.
Yeah, I think, and it's a good way to describe it. It's similar. A lot of stuff that I talk about with like my leap diagonal approach is like integrating deltas for that exact,
Right.
display. So I think that makes a lot of sense for folks that are kind of keying into this. So you named a couple things that you've been trading with this strategy. One of the questions that I got um, was, what are some products that you typically trade that you haven't favored quite as much just in the current markets? And you had an interesting answer when I asked you that before. So I'm curious. I'm curious, to explore that a little bit with you.
Yeah, my answer before was I've always kind of had a small universe of stocks that I've traded and products that I've traded. Pretty much I only trade companies that you would see in the headlines, like really well-known companies that have lots of activity in the options market. Those are the companies that I trade. I don't really venture off into more exotic companies that, are off the beaten path. My approach is just to stick to the companies that I know and not like know them in terms of how the stocks move or stuff like that, because
Sure.
obviously no one knows that, but just like the companies that if you were walking down the street and you mentioned a company name, any average person would know what company you're talking about. Those are the companies that I stick with primarily. um, One thing that's come to mind though is I used to trade a lot of SVXY.
Mm.
SVXY is an inverse volatility product. If anybody remembers XIV, RIP. If anybody remembers XIV, SVXY is essentially the same thing as XIV, except XIV never had tradable options. XIV, people just traded the shares. But SVXY had tradable options. So I used to trade a lot of SVXY. However, when the whole vol apocalypse happened, when XIV was terminated because it lost 95% of its value overnight, they actually reduced the leverage on SVXY. So it used to be a negative 1 times leverage, which meant essentially if VXX, it's essentially the opposite is VXX.
Right.
So if VXX went up 10% in one day, SVXY would go down 10% in one day.
Right.
But after that whole volatility calamity, I should say, they actually cut SVXY's leverage in half. So now it's a negative 0.5x. So
Where's the fun in that?
if VXX goes up 10%, then SVXY will go down 5%. And if VXX goes down 5%, SVXY will go up 2.5%. So yeah, I wasn't a big fan of the leverage cut. And they actually did the same thing in UVXY too.
Yeah.
UVXY was 2x and now it's 1.5. So they reduced the leverage in those products and that kind of eliminated some of the interest in it for me. So these days, if I'm trading a volatility product, it's most likely VXX. Actually, very recently, I had a nice trade in VXX, which I talked about a little bit on a live stream. But um, the VIX was at like 20, and the near term VIX futures were at like 25. And what happens is the VIX futures over time will converge to whatever index that they're tracking,
Right.
or futures traders will say the futures will converge to spot. So VIX is the spot volatility. VIX futures are kind of the future expected volatility, or what traders will have to trade if they want to trade the future and not actual spot, which if you want to trade spot VIX, you actually can't trade it. You have to trade the options, which are tied to the futures. But anyways, VIX was at 20. The VIX futures were at 25. And I was like, if the VIX stays here or goes lower, then these futures are going to converge down to the VIX index, and they're going to lose like 20% of value. So what I did is in VXX, I purchased 100 contracts of out of the money puts. And this was before the split. I think VXX was at like 13 or 14.
Mhm.
And I bought 100 of the 10 strike puts in VXX for like 7 cents each or 17 cents each. And what happened was exactly what I said. So the market was trending upwards and the VIX index was trending downwards, but there was such a premium in the futures to the VIX index that what happens is, since VXX is actually tracking the basket of these near-term VIX futures,
Mhm.
since they had so much value to lose to get to the VIX index, I thought it was extremely bearish for VXX. And so I just put on this long shot put option trade in VXX, and I purchased 100 contracts at 17 cents each. And I ended up closing all those out for more than $1. So
Yeah.
that was a really sizable trade. And that was probably the biggest winner I've had in VXX in a while. But that was the first speculative trade that I used in VXX that wasn't actually a hedge. Because sometimes I'll use VXX and buy some out of the money calls just to have some portfolio insurance.
Sure.
Because as we talked about earlier, if the market crashes, the VIX index will shoot up and that'll bring the futures with it. And since VXX is tracking the VIX futures, that means VXX will go up as well. So if
Right.
you look at what happened to VXX, in the coronavirus meltdown, VXX went from like $12 all the way up to like the 80s.
Yep.
And there are stories on Reddit where people made hundreds of thousands of dollars from that. Actually, it's funny. My brother had a position on, he's not going to like this. He had a position on where he actually bought a ton of VXX out of the money calls, and he spread off the risk way too early. And he eventually got out of the position. And if he would have held those options, he would have made like $250,000 at any of the prices where VXX was, 50 plus. But he did 10x his account. He went from like, he turned like a $5,000 an account into like 25,000. So it wasn't a 10x. It was
Yeah.
many multiples. But if he would have held those options, it would have been $250,000 trade.
The good old trader's
Hindsight's
hindsight, man.
2020.
Yeah.
But that gets back to what we said before: is if you have conviction in something happening, you can't take your risk off too soon. Otherwise,
Right.
you know, and that's not even options trading. That's also investing in stocks. Like, those headlines that say, if you would have invested in Amazon in
Yep.
2000 and you held till today, you would have turned $1,000 into 2.5 million or something like that. But what people miss is, for that $1,000 to go to 2 million, you had to watch the 1,000 go to 10,000 without selling. And then you had to watch that 1,000 go to 10,000. And then you had to watch it go to 50,000 without you selling. So the only
Right.
way you get to that 2 million is if you actually had the conviction to hold the whole time. And I think that's a really important concept just to throw into this conversation,
Yeah.
because that's my exact philosophy with Bitcoin. Because I bought a bunch of Bitcoin last year, and right after the depths of the coronavirus. So I didn't get to buy Bitcoin at like 5K, but I
Okay.
bought a bulk of my position at like 9 to 15,000. And I went into that position with a very long-term mindset, and it's gone really well thus far. But because I bought so much of it and because it's gone up in value, now it represents a really a really big portion of my overall wealth.
Right.
And most people would say, "Oh, you got to sell. Like, you got to take your profits." But I went into it with a certain goal in mind, which was to hold it long term. And getting back to the Amazon example, you can't turn $1,000 into 2 million without watching the 1,000 go to 10,000 to 50,000 without, selling it out. So I'm holding strong in my Bitcoin position, and it's deeply rooted in that exact same thought process as, those headlines where they say you turn this into this, but they don't talk about the in between.
Would
So
you do you integrate any like partial profit taking. Because for me, like I actually traded Bitcoin back in like 2013, and I held it for a while just because I like just randomly heard of it, was kind of curious, and as soon as I started seeing it, 4 years down the line, 5 years down the line, making kind of crazy moves, I started pairing the position until I eventually paired myself out of it all the way.
Yeah.
But one of the things that I integrate in a lot of my trading plans is partial profit taking. So, and obviously the idea is to secure some realized gains based on risk offered, and then still leaving a good portion on for future potential returns. And one of the things that I also like to highlight why I've gone that way is because for everybody, exactly like you said, right? The Amazon example, if you take 1K, would it be, 2+ million if you held the whole time? And then, if you kind of zoom that out, if you, picked a basket of 30 stocks and did that $1,000 in all of them, one of them, maybe Amazon, maybe not too
Right.
likely. You know what I mean? So
Right.
there's also that piece to it. So I'm curious if you integrate any like aspect of profit taking, or are you that resolute in this money's going in and it's staying there?
That's pretty much what you just said. So the money went in, and
It's fucking awesome.
I don't have any plans to sell it
That's
anytime
awesome.
soon.
So
Because
then,
this is a good point. Like that's a good argument too, is that I would never look at a stock right now, a publicly traded company, and say, this is the next Amazon.
right.
But I think in the case of Bitcoin, I think probability, like weighting the probabilities, I think Bitcoin has the highest probability of anything right now of being the next Amazon over the next 10 plus years, like longer than that, decades. Um, and I also fully expect or accept, sorry, not expect. I accept the risk that I have. And if it goes to zero, then I actually thought about this. It's some people might think this is stupid, but um, if Bitcoin were to go to zero, yeah, I would lose a bunch of money, but I will have put money where my mouth was, and I will have stood for something, and I will also come out the other end much smarter, because learning about Bitcoin has made me learn about a new technology and expand my mind, and also learn about some big macroeconomic topics like we've talked about with
Yeah.
inflation, and inflation being kind of the primary one, and look into the history of currencies and understand, why do they do it this way, and why don't we have a different approach where we keep the money supply the same. I think Bitcoin overall for me has been a net positive, and if I don't have a huge financial gain from it at the end of the day, that's fine. I accept the risk that I have, and I'm in it.
Yeah, that's awesome. It's honestly really, really cool to hear stories like that. And obviously, I'm rooting for you. I would love nothing more than to see a big video about you in 10 years. How you just bought some island and are now sailing around on a yacht. That would be dope.
Well, I'm not the Winklevoss twins. Unfortunately, I think the Bitcoin billionaire ship has sailed.
Yeah. And that definitely is a important part to bring in is, it's
Yeah.
I do think it's really difficult to price something like Bitcoin, right? Some people might say, well, isn't it priced in? And then, you kind of ask, well, what's priced in? It's
Yeah.
still being figured out how they're going to integrate it in
Yeah.
the economy,
I think
so
I think the comparison that people always use, this is kind of the most common valuation metric for valuing, or at least a big milestone for valuing Bitcoin, is people compare it to gold, because it
mhm,
has all the characteristics of gold, except it's better on basically every metric, with the exception of having a multi-thousand year history of being used as a store of value. That's really
right.
the only thing Bitcoin does not have that gold has, because Bitcoin has all the other characteristics except for that track record.
Well, you could argue that gold has a physical purpose. Not saying
Yeah,
that it's like,
that's true. That's true. So that's
yeah,
another argument too, is that gold has a physical use case,
right.
whereas Bitcoin doesn't have any physical use cases because it's it lives in the atmosphere essentially.
But what I always
um,
pair with that is that that's where Bitcoin's true value could be derived is from that
yeah, exactly.
because there is no physical component to it and the privacy components to it.
Right.
But anyways,
That's an interesting way to interpret it too, is that like in the US, we have the US dollar, and in the EU, they have the euro.
right.
So there's all these currencies, forms of money that are used in all of these different countries. And if you were to kind of zoom out on, if you just think of a kind of like a international space station view of Earth,
Hmm.
and you're watching all these countries come by, and then you see, the different currency symbols on each country.
Yeah.
But then you have the Bitcoin symbol, which is like in the atmosphere around the whole globe. So that's kind of the whole idea, is that
Shit, you
it's
just got a
it's
sales
it's
pitch right there. You need to get that on a marketing thing
it's
ASAP.
it's it's borderless. Yeah, maybe I should reach out to them and tell them to use that in some marketing materials. But where I was going with this is, people compare Bitcoin to gold. The market cap of gold is around, let's just say 10 trillion. I think it's like 9 trillion. I don't know the exact figure. But the market cap of Bitcoin is around 1 trillion. And so if you increase Bitcoin's market cap to be the same as gold, then you get $500,000 per Bitcoin. So that's the Winklevoss twins made a big write up about that, and that was their case, and that's how they backed into the 500K per Bitcoin. Was if Bitcoin matches gold and overtakes its market cap, it will be $500,000 per
Got it.
Bitcoin. But the interesting thing is, earlier we were talking about asset prices
Hmm.
and their performance. So this video that I'm writing that'll be out this week, I was actually looking at the year-to-date performance of certain assets. So I looked at the S&P 500. It's up about 12% year to date. Bitcoin's up 84% year to date. Real estate, I couldn't find a year to date metric, but I told you earlier I was looking at a real estate pricing index by the FHFA, Federal Housing Finance Agency, and they have a single family home price index based on sales. And January 2019 to January 2020, that index went up 6%. January 2020 to January 2021, that went up 12%. So
Right.
let's just say real estate year to date is up about 12 or like 10%.
Sure.
The interesting thing is, if you look at gold, gold is actually not doing well at all.
Right.
Gold is, let's see, where was so gold is down year to date. And that's very interesting for Bitcoin, because a lot of people, there's a lot of people that are big believers in gold, but they don't believe in Bitcoin.
Right.
But as I said earlier, Bitcoin has all the characteristics of gold except improvements in the characteristics. And it's very interesting that something like Bitcoin, if it's up 84% this year, then why is gold down? And if gold is seen as a inflation hedge, then why is gold down this year, given what we've seen in all other asset prices, and with gold being kind of like the go-to inflation hedge? That's an interesting thing. So
Yeah.
the argument there is the argument is that Bitcoin is eating gold. So people
Right.
are selling gold to buy Bitcoin, and that's why gold is down. Um, Again, I'm not a macro expert, and I don't know a ton about the gold market, but I do think it is very interesting that, given gold's characteristics and given the monetary policy and just the policy environment that we're seeing right now, and looking at all the other asset prices year to date, that everything is up except for gold.
Right. Yeah, honestly, that's a really interesting perspective. I can't say that's something I've personally thought about much is kind of the relationship between and Bitcoin directly. And it's a really good question because
Right.
I've heard a lot of people speculating on, a lot of people are moving from things like gold into real estate with rates being as low as they were and things like that. But
Yeah.
I honestly think there's a really good argument to say something like Bitcoin could absolutely be starting to take away a good portion of, gold's quote unquote market share as people are kind of starting to adopt that kind of thing. Yeah, that's a really, really curious.
Yeah.
curious question.
So I'm not, like I said, I'm not an expert on that, but I
Sure.
do think it is very interesting that based on our conversation earlier of, where do you put your money if you're trying to hide from potential high levels of inflation?
Yeah.
And we've seen all these other asset prices increasing exponentially. And it seems like that's happening. It seems like that's happening because you don't have any real returns in these low risk assets. You would think that gold would be up this year. Like you
Right.
would think gold would be up 10 to 15% this year, based on what we've seen in all the other assets and based on the monetary policy environment, but that's not the case. So I think it is very interesting.
Yeah, no, it's super curious. That's actually really good good note to end off on too, because I think I would be curious to hear what other people think about that.
Yeah. If we
Um
have any, if we have
yeah,
any
if
gold experts watching,
yeah.
please. If we
Help
have
us.
any gold experts watching,
Oh, furious right
they're probably
now.
like 6 beers deep right now, just
Yeah.
raging.
But yeah, no,
They're probably not happy with this conversation, but
I would be super curious to
I
hear
honestly
though.
I'm not a gold hater. I just think,
Yeah,
I don't know. I think Bitcoin is a much more elegant solution. And I think for me too, another thing to think about is that in Bitcoin, they say not your keys, not your Bitcoin.
right,
So what that means is that if you're not self-custodying your Bitcoin private keys, like you don't have a hardware wallet where you're storing your private keys, you're not keeping that safe, then you actually don't own the Bitcoin. So if you're
right,
keeping your Bitcoin on an exchange like Coinbase, technically they are the ones that are holding the keys to your wallet, and therefore you don't really own that Bitcoin. So I think the
right,
same thing is true for gold. I've
right,
actually looked into buying gold historically, and the only true way to really own gold is to buy physical bars of gold
right.
and put it in a safe in my closet.
Yeah,
And that just
exactly.
seems like way more of a pain in the ass than, um, having Bitcoin and having,
Little
these
salt
US
key or something.
yeah,
Yeah, look.
these little USB drives
I
hidden
tell
in
you what,
various
man, if you
places.
wanted to make build a bed frame out of Bitcoin keys though, that's not going to do it. So you need the gold bars, man.
Yeah, I guess so. I don't know, man. It's a very interesting thing. So like,
Yeah,
you want to physically actually hold the gold, then you got to actually buy the physical thing. Because if you
yeah,
buy something like GLD, you actually don't, you have kind of a paper receipt for gold, but like I said, if the gold is not in your possession, then technically you don't really own it. So it
right.
just seems like, comparing Bitcoin to gold in terms of custody, it's much more of a pain in the ass to actually hold physical gold compared to
Absolutely. And then
Bitcoin, which doesn't.
you also have the liquidity issue. You know what I
Yeah,
mean?
exactly.
Like now you have your, closet full of gold and you're like, well, I want some money for this
Exactly.
now. Like,
It would take me multiple days, if not weeks, to actually convert
yeah,
that into a different medium of exchange. Whereas
absolutely.
Bitcoin, you can settle basically any transaction value. I could literally move $1 billion or send $1 billion worth of Bitcoin across the whole globe, and it could be final settlement in less than an hour.
Yep.
So that's pretty compelling.
The fee might be a little brutal, but the
Yeah.
liquidity will be there.
No, yeah, for sure.
Yeah. So, anyways, yeah, super, super good to connect with you again, being sensitive of time. As always, it's a pleasure to kind of just talk a little bit about what we're seeing now.
Yeah.
It's fascinating, man. There's a lot of really curious things going on. It's really good to hear, the direction that you're kind of taking your brand. I'm
Yeah.
excited to see, what that turns into and follow along. And then as always, thanks for coming on. Looking forward to chatting with you again sometime.
Yeah, I'm super excited. Thanks for having me. And yeah, like you said, really nice chatting, and let's do it again at some point.
All right, man. Take care.